Good morning, everybody. I hope you can hear me okay. We're going to talk about a few different things that have to do with qualified mortgages and ability to repay, and then we're going to get some updates on different mortgage programs. So here is an agenda of today's class. We're going to talk about qualified mortgages, qualified residential mortgages and the difference between the two, the ability to repay, changes for FHA, changes for USDA, changes for the bond programs that are the TDHCA and TSHAC, and then we'll finish with changes for conforming loans. Feel free to ask questions anytime along the way. I'll try to make it pretty clear, but some of these topics are kind of mundane, and so if you get lost during my explanation, feel free to raise your hand electronically, and then we'll answer your questions. So first, a little background helps understand the current environment. I chose to do it with rhyme. The real estate collapse and mortgage crisis were results of poor decisions on a number of different fronts that ultimately caused regulators to put in what they think are safeguards to keep them from happening again. We can break the causes into categories of crime, subprime, climb, time, and prime. Sorry, that's the best I've got. So we'll start with crime. The real estate collapse and mortgage crisis were initially thought to be a result of subprime lending. And although we'll see later that they certainly contributed, they were not a major source. And had nothing else occurred, there wouldn't even have been a collapse nor a crisis at all. In fact, one major contributor was crime. For example, Taylor, Bean, and Whitaker committed the biggest bank fraud in history from 2005 until 2009, selling worthless mortgage securities that brought down Colonial Bank. You may be familiar with Colonial Bank because they used to have branches here in Texas, but they were based in the Florida or Alabama area and had branches all over the southeast. TB&W's fraud took down the bank entirely. Next, we also had Countrywide. Countrywide committed fraud in both prime and subprime lending throughout the 2000s, and its chief praised the company's practices publicly to prop up the stock price and thus enrich himself and his bonuses while he made negative comments privately. Bought by Bank of America, Countrywide contributed an estimated $40 billion in losses to Bank of America. The last I'm highlighting is Merrill Lynch. Merrill Lynch understated the risk in its mortgage portfolio by hundreds of billions of dollars. It too has been purchased by a weary Bank of America. When we look at subprime represented only 6.8% of the outstanding mortgages in 2007, but represented almost half of all foreclosures in the third quarter of that year. However, it was only a small catalyst. It was reported that subprime itself caused the crisis, but you can see from the chart that a similar rise in delinquency and foreclosures occurred in the recession of 2001 without a real estate collapse. However, this time, there was no rapid rise in home values to save borrowers, and the drop in rates that would have saved them in the past came later in the cycle. So what I'd like to point out to you is if you look on the left-hand side of the screen, you can see that that's the share of conventional prime mortgages that were past due in each of the years from 1998 through 2007 that go across the bottom. On the right-hand side, that's the share of conventional subprime mortgages that were past due in those same years. And so if you look back in the gray area, you can see that both the blue line and the, we'll call it yellow line for lack of a better color name, that both of those rose substantially during the period of the recession of 2001. If you look again, they went down all the way through 04 and 05 and started to pick up in 06 and 07. And so you can see that the peak of both in 07 were just about the same as they were back in 2001. The real estate collapse was largely precipitated by the unprecedented run-up in prices that was itself partly a result of low and no-doc loans, low start rate adjustable rate mortgages, or ARMs, and interest-only products. We didn't have as many of those products being used here in Texas as we did in California, Florida, Nevada, and Arizona, the four states that contributed the worst to the run-up in prices. But nevertheless, those kinds of mortgages were given a lot of credit for the problems that we subsequently suffered. This graph shows that the different kinds of loans participated in some degree because borrowers who normally couldn't afford a higher priced home became buyers. So they bid the prices higher. If you look at the years, and most of you were in the market at that time, and so you know about how the prices ran up from 04, 05, 06, and finally peaked at the end of 06, the beginning of 07. Those prices were bid higher by having many, many more buyers, way more demand, a classic example of demand exceeding supply driving prices higher and causing a vicious cycle until it finally stopped. So how did time contribute? Well, in fact, that run-up that I was just talking about caused prices to go up compressed into too short a time period. So the natural inclination was for it to go back to the channel that you see here in yellow, about where we are today. So starting all the way back in January of 76, you can see that home prices went up and went down. They certainly always stopped rising as much during a period of a recession, which is in blue. But you can see that they never went too far out of the channel going downward or too far out of the channel going upward until we got into that runaway inflation period between January of 03 through what we talked about a moment ago, which was the beginning of 07. The problem is that if you look at this chart, you can see that home prices never went terribly lower than the channel. They certainly did a little bit during 2010, 11, and 12. But all the things that the Fed did to try to keep the housing market afloat actually did work. The problem is that if you don't have a large enough sell-off below the channel, then you don't have as much room when prices start to rise again without running back into a bubble again. So the fear right now is that even though we did come out of the bottom, we don't want to have prices increase too fast and get back to where they were in 05, 06, or 07 for as many as perhaps 10 years. Maybe 20 years, and we're certainly headed to that point long before that time period. So although the crisis started with subprime mortgages hitting first, all mortgages ended up with a large increase in foreclosure, and this includes prime mortgages. If you take a look at the chart here, the two prime rates of foreclosure slowly increased, peaked later, and have only lately declined. So let's go back in the chart all the way back to, again, the 2001-2002 time frame when we hit that first recession, which is the gray bar on the far left side. And you can see that and I don't know if you can see the writing, but the red line is subprime fixed rate mortgages, and blue is the subprime adjustable rate mortgage. So the red and the blue are the two that you see that are above the other lines. The ones near the bottom would be the prime rate fixed rate mortgages in green and the prime rate adjustable rate mortgages, not prime rate, I'm sorry, I just mean prime. Prime fixed rate mortgages and prime adjustable rate mortgages that would be then in green and, well, I'll call it purple. Sure, it might be magenta. I don't even know what magenta is, so we'll call it purple. So what you can see from the graph is that when we hit the later gray period, the later recession period of just a few years ago, subprime adjustable rate mortgages took a huge increase. The subprime fixed rate mortgages were certainly higher, but they never went above the period that we had in the earlier recession in the 2000s. So it really wasn't subprime altogether so much as it was subprime adjustable rate mortgages. The interesting side note to this is that when the Fed started lowering interest rates, even the adjustable rate subprime mortgages had reasonable interest rates. What I'm trying to say is that all of those mortgages had some kind of an index, and then they had the margin that's added to the index. When the index went down to close to zero, then all you had really was the margin, and the margins were usually between 5 and 8%. So the interest rate that could have peaked as high as 13 or 14% actually came down, and those people were back to interest rates in the 5, 6, 7, 8% range. So they were affordable. Those were usually near their start rate. So if it was affordable when they started their mortgage, it was certainly affordable when we got to 2010, 11, 12, and even last year. The problem is most of those people took a strategic default. And many prime borrowers also chose to take a strategic default. In other words, they decided that since they were upside down on their mortgage and had zero or negative equity, that they would go ahead and bail out and get rid of the house instead of having a declining value. They really never thought that they'd be in the house long enough to recoup their investment, so they bailed out early instead. This drove prices down even faster. I'm not telling you something you probably haven't already read about, but it's important to know how this fed into QM and QRM, because it was the market's reaction, people's personal reactions to the subprime foreclosure rate that caused everything else to collapse along with them. So now, knowing that history, we can talk a little bit more about what the regulators did to try to stop that from happening again. Without going into the thousands of pages and hundreds of rules, the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, that we now call just Dodd-Frank, it created, among other things, the CFPB to be the central regulator of mortgage activities. It also required the creation, implementation, and oversight of all of the rules that exist, and those that would be written that govern mortgage origination and servicing. The part that relates to QM, QRM, and ATR stem from risk retention and ultimately liability. And don't worry, I am going to go into what QM, QRM, and ATR actually mean, but the bottom line here is that the rules are coming fast and furiously, and we still have over 100, maybe as many as 200 other rules that the CFPB is going to write. And the interesting thing about it, if you haven't heard this before, is that the CFPB is under the Fed, and so there is no legislative oversight of the CFPB. What this means is that your elected officials, from the President through Congress and the Senate, all regulators that have to do with CFPB are not governed by those whom we elect. So we don't have any direct control over who they hire, what they decide to do, the rules that they decide to write, how they're going to find people, and how they're going to regulate industries. All of that is coming from an appointed board, an appointed person who hires everybody else, and our legislators have absolutely no control otherwise. So let's go ahead and talk a little bit about what these things are. First, we're going to talk about qualified mortgages, or QM. So from here on out, I'm going to try to always say QM. QM started January 1st of this year. Lenders must assess the ability to repay. All right, so if a loan has the feature requirements necessary, then the law presumes that it's a qualified mortgage, and therefore the retention requirements are not needed to be met, and the lender is not open to liability to borrowers for not making sure that the borrowers were able to repay the mortgage. That's right, it's now the lender's responsibility if a borrower is found to have not been able to repay a mortgage, even if the borrower insists he wants it and promises to repay. So the QM is there to give lenders a safe harbor from liability. Let's go back through that one more time a little bit differently. QM has retention requirements that a lender must retain a portion of the risk for every loan that doesn't meet the QM requirements. The second thing is, if it doesn't meet QM requirements, then presumably the lender hasn't met all of the feature requirements or has not checked the ability to repay, and so that lender is open to more liability than a lender who has met the QM requirements. So in effect, lenders have a huge incentive to try to meet QM requirements. before I go any further, I do want to show that the lender is presumed to comply when the feature requirements are met, and I am going to go through what those feature requirements are in just a moment. But the QM can be under any one of the general definition that I'll be going through, the GSE eligible provision, or the small creditor provision. And I will go through each of these one by one next. So first, let's go through those product features. The mandatory product features of all QM loans come from the financial crisis that we just went over a moment ago. One of them is that regulators thought that too many loans had predatory points and fees. And so they've come back with a points and fees maximum of 3% of the loan amount for loans of $100,000 and more. Now they actually have a little bit higher percentages for loans that are less than $100,000, but since we're in a marketplace where most loans are over $100,000, I'm going to go ahead and focus on that. 3% for points and fees. Now, it's important to know that points and fees are not all closing costs, and they're not all fees that pass through a lender. The mandatory product features supersede the definitions and are always required, except in the notes that I give you in just a moment. So for the points and fees part, they don't include mortgage insurance, nor guarantee fees, for example, on a VA or a USDA loan. And as long as they're not upfront mortgage insurance on conventional loans that are not refundable and in excess of FHA's upfront mortgage insurance. So let me review that one more time. If it's a conventional loan and it has regular mortgage insurance that's paid annually in a monthly payment, then that's okay and it's not included in points and fees. It's just when it's upfront mortgage insurance, what we call single premium mortgage insurance, that you actually might run into a problem with exceeding the points and fees limit. So as an example, right now FHA's mortgage insurance is 1.75% upfront. So that's the benchmark against which the conventional mortgage single premium mortgage insurance would be measured. The single premium mortgage insurance then, if it exceeds 1.75%, it would be only that portion that exceeds 1.75% that would be considered a part of the points and fees limit. If they are refundable, then they also don't have to count in the points and fees limit if they're in excess of FHA's upfront MI. So, I may not have said that as clearly as I'd like, so I'm going to go through it a little bit differently one more time. Single premium mortgage insurance counts in the points and fees if it's not refundable. And if it is refundable, then it's only that portion that's above 1.75% for the current FHA upfront mortgage insurance premium. Where there might be a problem is if FHA in the future lowers their upfront mortgage insurance premium to say 1 or 1.25%, because we've had them that low in the past. Well, if that happens, then the QM definition is going to go with it, and so the points and fees for single premium mortgage insurance might get impacted for those that are refundable. I hope that's clear. If not, feel free to raise your hand and ask a question. Yeah. Oh, make sure you type in the question. Sorry. So once again, non-refundable upfront mortgage insurance premiums for conventional always count in full in the points and fees limits. This would really only be a problem when you have a 95% loan with mediocre credit scores where the upfront mortgage insurance premium for conventional would be rather high, and you have a lower loan amount so that the 3% ends up being too small. Now, it's interesting to note that seller-paid costs are excluded from the points and fees limit, and bona fide discount points that are used to buy down a rate are also excluded from the limit. So in addition to any kind of third-party fees that are not a part of the loan fees, you have a lot of room for that 3% limit. Did we have a question, Karen? Okay. So with a qualified mortgage, the general definition then, assuming that the mortgage does meet the product features that we just discussed that are mandatory, then the general definition is that the DTI not exceed 43%. And that's really it. The most important part of all of the ability to repay, oh, you know what? I did go past one thing. Let me go back a moment. I forgot the other risky features. So I went too fast and talked about the 3% limit and forgot about the other risky features. Let's review those on this slide. The other risky features are that you cannot have negative amortization, you can't have an interest-only feature to the loan, and it cannot be a balloon loan, except balloon loans are allowed by small creditors that hold those loans in portfolio until January 10th, 2016. So in my haste, let me just review this again so we're all on the same page. The mandatory product features of all QM loans are the limit on points and fees and not having those risky features that you see on your screen right now. So we move forward then. Those were the provisions that the creditors have to worry about, those being that they not exceed 43% DTI and that they have the product features that are necessary. Those give a lender QM coverage so that their liability is reduced and they don't have to have the extra retention. The second bullet point was that a QM also has a GSE eligible provision that is temporary, and so we'll go over that next.
Okay, Scott, we have a question here. Chris Hall wants to know, what is negative amortization?
Negative amortization means that instead of like a normal loan where you're paying down principal along with the interest that you pay each month, and unlike interest only where you pay just interest and no principal, negative amortization means that you're actually going the opposite direction. Your minimum payment doesn't even cover all of the interest that's due for that month. And so the remaining interest that didn't get paid in the monthly payment gets added back to the loan balance. Negative amortization was a part of very, very many of the pick-a-pay or option pay kinds of monthly adjustable rate mortgages back in the late 1990s and early 2000s. And when done correctly, they allowed for a small amount of negative amortization by allowing a borrower to have a very low minimum payment. And those minimum payments went up every year, so eventually the negative amortization went away, and the borrower was actually paying principal along with the interest in the payment. The problem was that many lenders started rolling out negative amortization arms that had a starting payment and a minimum payment that were so phenomenally low so that people could afford more house, that they had huge negative amortization at a time when house values weren't rising anymore. And so it compounded the mortgage crisis and, by extension, the real estate collapse. Chris, I hope that answers your question. So now let's move back to the slide, and you see the GSE eligible provision covers any loan that's eligible for purchase, guarantee, or insurance by what we call the government-sponsored entities, Fannie Mae and Freddie Mac, as well as FHA, VA, and USDA. So basically what the government said was, if it's a government-tied mortgage, then it will have a temporary eligibility for QM regardless of the debt ratio. So this is important because as long as Fannie Mae and Freddie Mac continue to exist, then the GSE eligible provision will continue to cover those mortgages, and people will be able to have a debt ratio that exceeds 43%. Now you may think that a debt ratio above 43% seems excessive, but who's to say that a very, very strong borrower with a debt ratio of 44% isn't a good loan? What if you've got somebody who has a 46% debt ratio, but they're putting 50% down? I think we'd all agree we'd probably lend our own money if we had it to somebody who was going to put 50% down with real estate as the collateral. So this GSE eligible provision allows for the automated underwriting systems, Desktop Underwriter, and Loan Prospector of Fannie Mae and Freddie Mac to give approvals that the systems deem worthy with debt ratios as high as those systems allow. Currently, Fannie Mae doesn't allow above 45%, and Freddie Mac I've seen allow as high as 49%. FHA, you'll see approvals as high as 50 or 55% from time to time when you've got somebody who's considered a strong borrower. VA uses different measures altogether where the debt ratio may be limited to 41%, but with a strong amount of residual income, then VA can take that debt ratio above 50% as well. And USDA, believe it or not, has its own type of automated underwriting system that's called GUS, and GUS allows debt ratios that exceed 41 to 43% fairly regularly with compensating factors as well. Now, a strong borrower isn't really defined. It just means some kind of strength in terms of down payment, credit score, or reserves after closing in terms of cash, liquid assets that would be in accounts after closing. So there are a lot of different ways that you might have a strong borrower that the automated underwriting systems would deem worthy of a higher than usual debt ratio. It's important to note that the GSE eligible provision ends when FHFA conservatorship ends. In other words, when the government doesn't have Fannie Mae and Freddie Mac in conservatorship anymore, then the GSE coverage for debt ratios above 43% would end with it. Government loans will be covered until an agency issues its own rules. So if FHA were to come along in 10 years and say that they wanted their debt ratios not to exceed 46%, then that would be allowed. Or the final one would be January 10th, 2021. So whichever of those things happens first is going to be the end of the GSE eligible provision that covers QM. I'm looking at January 10th, 2021 because as far as I'm concerned, I can't see any government of ours coming to an agreement on ending Fannie Mae and Freddie Mac as they are, or at least as some kind of an entity going forward with private money replacing them, because even the most aggressive kinds of projections are saying that it could be as long as 5 years through a transition period, and 2021 is only 7 years away. So I plan to retire January 10th, 2021 when all this falls apart. The third provision is what we call the small creditor provision. The small creditor provision covers banks, credit unions, any kind of lender like that that has assets of less than $2 billion, originates less than 500 first lien mortgages per year. Those loans are held in portfolio, and that they considered or verified the debt to income ratio. This is very important because it doesn't say that they have any kind of a limit on the DTI. It's just that the small creditor has to have considered and verified the DTI. It's also important to note that it's all four provisions. In other words, the small creditor provision does not allow for only to be less than $2 billion in assets. It's and, all four together. This allows small creditors to do some things that the larger creditors won't be able to do. Of course, if you're doing less than 500 loans a year, you're not doing that many loans anyway. So when we talk about ability to repay then, we're deciding whether a borrower has exhibited the ability to repay the mortgage in ways that lenders must look at specific underwriting factors. But they don't carry any specific standards. So let me say that again. They have to look for certain factors, but they don't have any kind of standards. So for example, in the first bullet here, in ability to repay, we have the current or expected income or assets. But the government didn't say what type or kind or limit on current or expected income or assets. As a result, if a loan is outside QM, but the lender would like to avoid litigation, it can prove that it underwrote an ability to repay with all of these points in the bullet points checked off. The lender would go through and make sure that each of these was checked And then if so, then the lender could avoid litigation by proving that it had proven the ability to repay. It's important to note that it specifically does not exclude what otherwise might be considered risky features, as long as the lender verifies the ATR. So legal claims against a lender for failing to verify the ATR are limited to 3 years unless it's in a foreclosure. A foreclosure goes beyond 3 years, but otherwise the statute of limitations is 3 years. So in that list of ability to repay, we've got current or expected income or assets. So really that should be considered 2 bullet points, but by the government's definition it's 1. Current income, current assets. Current employment status. The monthly payment on the covered transaction. So here we're looking at just principal and interest and or mortgage insurance if there is any. The monthly payment on any simultaneous loans. So here we're talking about tandem loans that we might call an 80-10-10 or an 80-15-5. Monthly payment for mortgage-related obligations. So we often think of those as taxes and insurance. And then, of course, we go to the other aspects of the DTI, which would be the current debt, alimony, child support, any of those kinds of ongoing obligations. Next, we look at the debt ratio or residual income. And this is very important because in the past, lenders have only looked at residual income for VA loans. To define residual income, the way I like to think of it is, what money do we have left over at the end of the month? You've paid all your bills, and you still have residual income left over. So debt ratio is your overall debt divided into your income, and that's gross income. While residual income says, if your debt ratio is high, but you're a very, very high earner, let's say that you earn $20,000 a month, and you still end up with $10,000 a month in residual income, most people would consider that $10,000 a month is probably sufficient after you've paid all of your debts to be able to continue to survive. That's where residual income comes in. So if we had a $20,000 a month income and a $10,000 debt, then that's a 50% debt ratio. But the $10,000 a month in residual income lets the lender feel pretty secure that this borrower can afford the house payment. And then finally, credit history. Notice that it doesn't, again, have any kind of a standard, so it doesn't say that the credit has to have a credit score above 620 or above 640. As a matter of fact, it doesn't say any number at all. So the credit history part of this is simply that, as with the other bullet points, the lender has to check to make sure that they have the ability to repay based on their own internal guidelines of what ability to repay actually means. Once they have checked all of these bullet points, and the lender is comfortable that this borrower has the ability to repay, then the lender can make the loan and not have the extra liability. They have that safe harbor that we talked about. So we move now from QM to QRM. The qualified residential mortgage, believe it or not, is separate and different from the QM as far as Dodd-Frank is concerned. The qualified residential mortgage rules were that a lender was required to keep 5% of the mortgage in its portfolio so that it would keep some of the risk. And the reason for this was simply that during the collapse of Bear Stearns and Lehman Brothers, which of course Lehman Brothers was the one that was actually left to fully collapse, one of the knocks against them was that they would sell all their mortgage-backed securities into the secondary market and not have any liability themselves. And so what regulators found, looking back, was that they would publicly say that these were great mortgages or that the securities were backed by great borrowers. And then behind closed doors, they'd laugh about how much crap they were trying to sell to people who were buying their mortgage-backed securities. So the regulators said, you're going to have to keep 5% of all mortgages you do in your portfolio so that we can see that you really do feel that these mortgages are strong enough to be worthy. The second part of QRM was it was feared to include large down payment and lower debt ratios. And so the government decided that since QRM might require as much as 20 to 30% down or debt ratios below 35%, that perhaps it was a better idea not to have QRM be separate and different from QM. So the final rules align the two together. So QRM is aligned with QM and ATR, that any loan that is QM is automatically considered to be QRM. It includes the 43% debt ratio, and it doesn't have any size down payment requirement. We have to give credit to NAR and the Mortgage Bankers Association for rallying Washington and to make sure that QRM wasn't a completely different and higher kind of a threshold that would have caused the housing market to collapse again. So that's where our TREPAC dollars and MORPAC dollars go to work for us. So the bottom line is now that as much fears we had about QRM, it's really about the same as QM, and we don't have to worry about it too much. Now let's start talking about some of the changes in the marketplace. First, we'll talk about the changes for FHA. There are two types of major changes for FHA that you would want to know about that have come about in the last year or so. One of those has to do with major derogatory credit, and the other has to do with mortgage insurance. For the derogatory credit part, the debts that we talk about here, let me go back. We're first going to remind everybody that we do have new higher loan limits of $287,500 for single-family residences in the Dallas-Fort Worth area. So that's good news because we've had $271,050 for a very, very long time. This allows minimum down payment on FHA for sale prices above $300,000. Okay, now we're going to go to major derogatory credit and disputed accounts. First thing that you need to know is that any time that somebody has cumulatively less than $2,000 in collections, no action would be required. The second would be that if you do have a cumulative of equal to or over $2,000 in collections, then a monthly payment will be required to be included in the debt ratio, even if there is no current monthly payment required. So if you have a collection account and the collection agent is simply trying to collect the debt and there is no monthly payment, then the lender has to assume a certain minimum payment to be included in the debt ratio. Now, if they do have a minimum payment, that's what would be included in the debt ratio. Finally, disputed debts of over $1,000 or equal to $1,000 force a downgrade of the file to manual underwriting. What this means is that where normally we could use the automated underwriting system, the FHA total scorecard, and allow debt ratios to be higher and things like that, you can't do that when you have a downgrade to a manual underwriting. So if you have disputed debts of over $1,000, then the borrower would be better off undisputing those debts, or they're going to have to face the manual underwriting. Seems we have a question now.
Yes, Scott, we have a question from Jimmy, and Jimmy wants to know, it says regulators, is the OFEHO one of the GSE regulators? Please comment.
As far as I know, they are still, but the predominant regulator for the GSEs is the FHFA, and of course above them the CFPB is the rulemaking body. But I don't know too much about I can't even say it, OFHEO or however they say it. I don't think it's OFEHO, but regardless, I do believe they still exist. But what's happened with the CFPB is they've taken a lot of the regulatory portions from other regulators and put them all under the CFPB. All right, so back to FHA. Oh, I do want to point out one more thing about the debts. The debts of a non-borrowing spouse are included in Texas because we are in a community property state. Medical collections are never included in these cumulative amounts for that $2,000 limit. And disputed accounts of a non-borrowing spouse don't count in the $1,000 limit for the downgrade to manual underwriting. So let's go through that one more time quickly. The debts of a non-borrowing spouse are included. but the disputed accounts are not included for the downgrade. Those disputed derogatory credit accounts, by the way, are considered disputed charge-off accounts, disputed collection accounts, and disputed accounts with late payments in the last 24 months. So you could still dispute things like the name being incorrect, the address being incorrect, and things like that. Another major change for FHA is the Back to Work program. For borrowers who have experienced an economic event and can document that certain credit problems were the result of either a loss of employment or a significant loss of household income beyond the borrower's control. What's interesting about this is that it includes bankruptcy, foreclosure, and short sale. If the borrower's loss of income or employment or both caused a reduction in the borrower's household income of at least 20% or more for a period of at least 6 months, then they might be eligible for the Back to Work program. The onset of the economic event is the month of the loss of the employment or income, and the recovery is the reestablishment of satisfactory credit for a minimum of 12 months. This means no housing delinquencies for over 30 days, not more than one over 30-day late for other credit, and no non-medical collections during that time. Now, clearly the borrower has to have demonstrated a full recovery from the event, and the borrower has to complete housing counseling so that we can make sure that we don't have any problems in the future. Last thing I want to show you about the changes for FHA, you've probably heard about them, but it's good to see them in a chart, and that has to do with FHA mortgage insurance premiums. For a loan to value in the gray area on the left, 95% plus, then those loan terms of greater than 15 years have a 1.35% per year mortgage insurance premium that lasts for the life of the loan. And 15 years or less has jumped up to 0.7% per year for the life of the loan. As a matter of fact, if you decrease the loan to value as far as 90%, you still have 1.3% per year for those loans greater than 15 years and the same 0.7% per year for those that are 15 years or less for the entire life of the loan. The only time the borrower gets a break is when they put more than 10% down. And in that case, for both 15 years and above 15 years, the mortgage insurance premium lasts for only 11 years. Next, we'll go to USDA. It's pretty quick and simple. The upfront mortgage insurance, we don't actually call it mortgage insurance for USDA, it's called a guarantee fee. The upfront fee has changed to 2%, can be financed, and then the annual fee has increased to 0.4% per year. This too lasts for the entire life of the loan. For some reason, the congressional rules, the law that said that at 78% mortgage insurance premiums should be dropped, doesn't seem to apply to FHA or to USDA guarantee fees. Another change for USDA is that the 620 credit score allows streamlined underwriting, so few lenders will approve less than 620 credit. They're allowed to, but they don't have the streamlined underwriting. So you might think that if they had a 615 or 619 credit score, the lender might go out on a limb for it, but otherwise they probably wouldn't. A 660 or higher credit will allow for extended debt-to-income ratios without compensating factors. So what I'm saying here is that if they have a 659 or below credit score, they must have some strength to offset this credit weakness in order to have a debt ratio that is beyond the normal limits. Those kinds of compensating factors, again, are like we talked about before for strong borrowers, which would be maybe a down payment with USDA or cash reserves, long employment history, a low increase from their current housing payment to a future housing payment with the new loan, things like that. The changes for the bond programs, we'll cover TDHCA first. TDHCA is the Texas Department of Housing and Community Affairs, and it covers all of the state of Texas. What I'm showing you here would be the new income limits and purchase price limits for both Dallas and Fort Worth areas. The Dallas area includes all the counties that are contiguous with Dallas County, so it includes Collin County, Rockwall County, all those counties. The income limit is now $67,900 for a family of 1 to 2 people, including children, and it goes up to $78,085 per year for a family of 3 or more. It's important to note that they are going to look at all family income, even if it's a teenager in the household. The purchase price limit is $250,200, and that is regardless of the family size. Next, for the Fort Worth area, the TDHCA has an income limit of $65,800 for a 1 to 2 person family and $75,670 for a 3 or greater sized family. Notice that the purchase price limit is the same for both Dallas and Fort Worth metro areas. T-Shack, which, by the way, don't take me to task for the fact that TSAHC doesn't spell T-Shack. I didn't name it, but that's the Texas State Affordable Housing Corp. In the Dallas area, the income limit is much lower than TDHCA. It's at $54,000 for any family size and all borrowers except for HEROES. So for those, the income limit would be $67,500 for a family of 1 to 2 people, or $77,625 for 3 plus in the family. Notice that the purchase price limit is still the same as it was for TDHCA. So what is a HERO? HEROES include teacher, fire, police. We hear about those all the time. What's interesting is here it also includes corrections officers and employees, as well as veterans. Now, the main reason you'd want to know the difference between the T-Shack and the TDHCA, other than the fact that the income limit is lower, you can see Fort Worth area has an even lower limit of $52,640 for any family size, and all borrowers except HEROES, whose limit is the higher limit. What is interesting about this is that there's no recapture on sale. So when you're doing a TDHCA loan, the borrower could face a recapture tax that could be pretty sizable. It can be as much as 50% of the profit that they make on the sale of the house. There are a lot of guidelines to that you can look up on the tdhca.org website to find those. But the important thing is that T-Shack has eliminated the recapture upon sale. So most people are better off looking at the T-Shack loan as opposed to the TDHCA loan, as long as they qualify on the income side. All right, looks like we might have, okay, so a question that Roxy had herself was to explain, it wasn't, okay, they may want to know, is what the recapture tax thing is. Now she's hitting me. But anyway, the recapture tax, again, I don't want to go into too much detail on it, but a recapture tax is simply a real federal tax that is levied because somebody's income went up too much during the time period they own the home, during the first 9 years of owning that home. And so the government wants you to pay a tax for having used a program that got you a zero down payment loan. So that's basically it. And so now we'll go finally to the changes for conforming loans. Now obviously Fannie Mae and Freddie Mac change things all the time, but most of their changes come out when they come out with a new release of either Desktop Underwriter or Loan Prospector. And this is what happened in the fall. Fannie came out with DU 9.3 and required that instead of only having 1 monthly statement for assets, now 2 monthly statements are required. This is interesting to me because when I first got into business, we had to have 3 months of monthly statements. So we went from 3 to 1 and now back to 2. The reason this is important is because borrowers can save for their down payment and they can get a gift for their down payment, but we're looking to make sure that they don't have unexplained large deposits, and large deposits are considered anything more than 25% of their gross monthly income. And so what you've basically got here is making sure that the borrower hasn't borrowed money for the down payment, that they got their money from a legitimate source. The other thing is that you may have heard that Fannie Mae and Freddie Mac eliminated 3% down payment loans. They're now down to 95% maximum debt ratio, regardless of what kind of program, regardless of credit score. That is the absolute maximum. Now, I will say that I heard yesterday in Metro Texas' great affiliate forum industry update that One of the Fed officials said that she thought that there were 3% down payment loans in the marketplace offered by private lenders. I can tell you that other than hard money, I have not heard of anybody going above 95%. And in fact, it's pretty much considered to be very reckless to make a loan above 95% anymore, even though FHA and USDA have pretty good results with their zero down programs. But for some reason, when it comes to conforming loans, they have not performed very well when the when the loan to value was above 95%. So this is interesting that there might be private money out there. I haven't heard about it yet.